I need to have a serious conversation with you today about something most financial advisors won't discuss openly. It's not because they're dishonest. It's because it makes people uncomfortable. But after managing billions of dollars through some of the most volatile periods in modern financial history, I've learned that uncomfortable truths are often the most valuable ones to confront head-on. I'm Peter Lynch, and during my 13 years running the Fidelity Magellan Fund, I learned to see past the headlines and focus on fundamental economic realities. Today, we're going to talk about what happens if the US dollar experiences a significant sustained decline in value, and more importantly, which 5 specific assets would not just survive, but potentially explode in value during such an event. Now, before you think this is some alarmist doomsday scenario, let me be clear. I'm a lifelong optimist about America. I've built my entire career betting on American ingenuity, innovation, and resilience. But true confidence isn't about ignoring risks. It's about preparing for them rationally while maintaining faith in our capacity to adapt and overcome. The US dollar faces mathematical realities that can't be dismissed. We've increased the money supply dramatically. Our national debt now exceeds our annual economic output. Global economic powers are increasingly conducting trade in currencies other than the dollar. These aren't conspiracy theories. They're verifiable facts that create real risks for anyone holding their entire net worth in dollar-denominated assets. So today, I'm going to share with you the 5 assets that would likely surge in value if the dollar weakens significantly. These aren't speculative gambles. They're productive assets based on timeless principles of value investing that I've relied on throughout my career. Whether the dollar maintains its strength or experiences decline, these assets represent sound long-term investments. But if currency devaluation accelerates, they could provide exactly the protection you need. Before we dive into the specific assets, you need to understand what currency devaluation actually means and why it's different from normal market volatility. When I talk about dollar devaluation, I'm not talking about the dollar losing 2% of its value over a year due to normal inflation. I'm talking about a sustained, significant loss of purchasing power that fundamentally changes the economic landscape. History provides clear examples. In the 1970s, the dollar lost approximately half its purchasing power over a decade due to sustained high inflation. What cost? $1,000 in 1970 required over $2,000 by 1980. Retirees on fixed incomes were devastated. Savers who held cash and long-term bonds saw their wealth evaporate in real terms. More extreme examples exist globally. Germany's Weimar Republic in the early 1920s saw hyperinflation destroy the mark. Argentina has experienced multiple currency crises. Venezuela's bolivar has become nearly worthless. These are extreme cases, and I'm not predicting America faces hyperinflation. But even moderate sustained devaluation, say 5 to 8% annually over a decade, would cut the dollar's purchasing power by 40 to 60%. The key question isn't whether this will happen. Nobody can predict the future with certainty. The key question is, if it does happen, what should you own? That's what these 5 assets answer. Asset number 1, quality dividend-growing businesses. The first and most important asset to own if the dollar declines is something I spent my entire career focused on. High-quality businesses with durable competitive advantages and growing dividends. These are companies that produce real products and services people need, that have pricing power, and that can raise their dividends year after year. Let me explain why these businesses are the ultimate currency hedge. When a currency weakens, the nominal price of everything rises. If the dollar loses half its value, a bottle of Coca-Cola that costs $2 will eventually cost $4. The company's revenue measured in those devalued dollars doubles. Its earnings rise. Its dividend payments increase. The stock price, which represents ownership in this productive enterprise, rises to reflect the new nominal value of the business. This is fundamentally different from owning bonds or holding cash. If you own a bond paying 5% annually and the dollar loses half its value over 10 years, you're still receiving the same nominal number of dollars, but those dollars buy half as much. You've been destroyed. If you hold cash, you've lost half your purchasing power directly. But if you own Procter & Gamble, Johnson & Johnson, or Coca-Cola, these companies simply raise prices. Their revenues adjust upward, their dividends grow, you maintain purchasing power because you own a productive asset, not a promise to be paid in a potentially devaluing currency. During my time at Magellan, I focused on companies with several critical characteristics. and these same characteristics make businesses excellent currency hedges. First, durable competitive advantages. These are what Warren Buffett calls moats. They're the reasons competitors can't easily steal market share. Strong brands like Coca-Cola or Disney create customer loyalty. Network effects like Visa or MasterCard become more valuable as more people use them. Cost advantages like Walmart's scale allow them to underprice competitors. Regulatory advantages like utility monopolies prevent competition entirely. Second, pricing power. This is absolutely critical for currency protection. Can the company raise prices without losing customers? Companies selling essential products, toothpaste, medicine, electricity, have strong pricing power. Companies selling commoditized products, generic gasoline, bulk steel, have weak pricing power. In a currency devaluation scenario, pricing power determines which companies can maintain real profitability. Third, capital efficiency. The best businesses generate high returns on invested capital without requiring constant reinvestment. They throw off cash that can be returned to shareholders as dividends. These cash flows provide income that grows with inflation, unlike bond coupons that stay fixed. The companies I find most attractive for currency protection are those I called stalwarts during my Magellan years. These are large, established companies in stable industries that grow earnings 7 to 12% annually and pay growing dividends. Think of companies like Johnson & Johnson in healthcare products, PepsiCo in food and beverages, Colgate-Palmolive in consumer products, Procter & Gamble in household goods, Walmart in retail, Home Depot in home improvement. These businesses have existed for decades or even over a century. They've survived the Great Depression, multiple recessions, the 1970s inflation, the 2008 financial crisis, and the pandemic. They keep producing, keep earning, and keep paying dividends through every economic environment. For investors seeking currency protection, I recommend allocating 40 to 50% of your portfolio to a diversified collection of these quality dividend-growing businesses. You can build this through individual stock selection if you enjoy research, or through dividend growth ETFs that hold baskets of these companies. Here's what this looks like in practice. Imagine you own $100,000 worth of quality dividend stocks yielding 3%, generating $3,000 in annual dividends. If the dollar loses 30% of its value over 10 years, but these companies raise dividends by 6% annually, which many have done historically, your annual dividend income grows to approximately $5,300. In today's purchasing power, accounting for the currency devaluation, that's still worth approximately $3,700, preserving most of your real income. Meanwhile, the stock prices have likely risen significantly in nominal terms as the market revalues these productive assets in the devalued currency. Asset number 2, real estate and real estate investment trusts. The second asset that explodes when currency weakens is real estate, particularly income-producing property held through real estate investment trusts or REITs. Real estate is the classic real asset, meaning its value is tied to physical property rather than financial promises. Throughout history, real estate has been one of the most reliable hedges against currency devaluation. There's a simple reason. You can't print more land. The supply is fixed. When currency supply increases dramatically, the nominal price of fixed supply assets rises proportionally. This is basic supply and demand economics applied to money itself. But I'm not talking about speculative real estate plays. I'm not recommending you buy vacant land hoping someone will pay more later. I'm talking about productive real estate that generates income. Specifically, I'm talking about REITs that own and operate income-producing properties. Why REITs rather than directly owning property? Several reasons. First, diversification. A single residential rental property concentrates your risk in one location, one building, and one or a few tenants. A REIT owns dozens or hundreds of properties across multiple markets. Second, professional management. REITs are managed by real estate professionals who handle tenant relationships, maintenance, financing, and all operational headaches. Third, liquidity. You can sell REIT shares in seconds. Selling a physical property takes months. Fourth, legal requirements. REITs must distribute at least 90% of taxable income as dividends, creating high current yields. The types of REITs I find most compelling for currency protection are those focused on essential infrastructure and properties with long-term leases that include inflation adjustments. Industrial and logistics REITs that own warehouses and distribution centers. E-commerce is driving sustained demand for these properties. Residential apartment REITs in growing markets. People always need places to live, and rents adjust upward with inflation. Healthcare REITs that own medical office buildings, hospitals, and senior living facilities. Aging demographics drive demand, and healthcare is non-discretionary spending. Infrastructure REITs that own cell towers, data centers, and fiber networks. Our digital economy requires these assets, and lease contracts often include inflation escalators. The key is understanding how REITs perform during currency devaluation. When the dollar weakens and inflation rises, several things happen simultaneously. Property values rise in nominal terms because real estate is a fixed supply real asset. Rents increase because landlords pass through higher costs and because nominal incomes are rising. Mortgage debt, if the REIT has fixed-rate mortgages, becomes cheaper in real terms as it's repaid with devalued dollars. REIT dividends increase as rental income grows. I saw this dynamic play out during the inflationary 1970s. While bonds and cash were devastated, real estate owners did remarkably well. Property values soared in nominal terms. Rents increased substantially. Owners with fixed-rate mortgages saw their debt burden shrink in real terms. The same pattern would likely repeat in a future dollar devaluation scenario. For currency protection, I recommend allocating 15 to 25% of your portfolio to a diversified basket of high-quality REITs focused on essential property types. Avoid REITs focused on retail malls or office buildings, which face structural headwinds from e-commerce and remote work. Focus on industrial, residential, healthcare, and infrastructure REITs with strong balance sheets and histories of dividend growth. One important note, REIT dividends are typically taxed as ordinary income rather than at the lower qualified dividend rate. This makes REITs ideal for holding in tax-advantaged retirement accounts, where you can defer or avoid this taxation. Asset number 3, commodities and commodity-producing businesses. The third asset class that thrives during currency devaluation is commodities, particularly energy and agricultural commodities, and the businesses that produce them. Commodities are the ultimate real assets. They're physical goods with intrinsic utility that can't be created by printing money. Throughout human history, when currencies weaken, commodity prices rise dramatically in nominal terms. This isn't complicated economics. It's simple mathematics. If the money supply doubles, but the supply of oil, wheat, copper, and gold remains relatively fixed, the nominal price of these commodities in currency terms must rise. During my career, I invested in many commodity-producing businesses, though I always focused more on the quality of the business itself rather than trying to predict commodity price movements. But I understood the fundamental relationship. Commodity producers are natural inflation hedges because their revenues are directly tied to commodity prices that rise with currency devaluation. Let me focus on 2 commodity categories I find most compelling: energy and agriculture. Energy commodities like oil, natural gas, and refined products are absolutely essential to modern civilization. We can't run factories, transport goods, heat homes, or power vehicles without energy. Demand is relatively inelastic, meaning people will pay higher prices rather than use dramatically less. When currency weakens, energy prices rise, often dramatically. The companies I find most attractive aren't the high-risk exploration companies trying to find new oil fields. They're the established integrated energy companies with diversified operations, strong balance sheets, and long reserve lives. Companies like ExxonMobil, Chevron, and ConocoPhillips own vast energy reserves that get revalued upward in nominal terms when the dollar weakens. They also typically pay substantial dividends that can increase as energy prices rise. Agricultural commodities represent the other essential category. People need to eat regardless of currency values or economic conditions. Food is non-negotiable. When currency weakens, food prices rise because the real resources required to produce food, land, water, labor, seeds, fertilizer haven't changed. Only the currency measuring their value has changed. The challenge with agricultural commodities is they're difficult for individual investors to own directly. You can't easily store wheat or corn in your garage. Commodity futures are complex and unsuitable for most investors. The practical solution is owning agricultural businesses and farmland operators. I'm particularly interested in companies that own or operate productive farmland, food processing and distribution businesses with strong brands, and agricultural equipment and seed companies. These businesses benefit from rising food prices while providing professional management and diversification. For commodity exposure focused on currency protection, I recommend allocating 10 to 15% of your portfolio to a combination of energy companies and agricultural businesses. You can implement this through individual stocks or through commodity-focused sector ETFs. The key insight is this: when currency weakens, money flows out of financial assets and into real assets. Commodities are among the most real assets available. They have tangible physical existence and practical utility. Unlike a bond, which is a promise to pay you devaluing currency, a barrel of oil or a bushel of wheat has inherent value that adjusts automatically with currency changes. Asset number 4, international businesses earning foreign currencies. The fourth asset that can explode during dollar devaluation is one that many American investors completely overlook: high-quality businesses based outside the United States that earn their profits in other currencies. This isn't about being unpatriotic. It's about intelligent diversification and risk management. Let me explain the mechanics. If you own 100% of your wealth in US dollar-denominated assets, stocks of US companies earning dollars, bonds paying dollars, real estate rented for dollars, you have a massive concentrated bet on the dollar's continued strength. If the dollar weakens significantly, your entire net worth suffers simultaneously. But if you own businesses that earn euros, Swiss francs, Japanese yen, British pounds, or other major currencies, something interesting happens when the dollar weakens. Those foreign earnings become worth more when converted back to dollars. You get a double benefit: the underlying earnings growth of the business itself, plus the currency appreciation effect. Let me give you a concrete example. Imagine you own shares in a Swiss pharmaceutical company that earns its profits in Swiss francs. Over 5 years, the company grows its earnings by 25% in franc terms. During the same period, the dollar weakens by 20% against the franc. When you measure your investment return in dollars, you've gained approximately 56%, not just the 25% operating growth. The currency movement amplifies your return. This works the opposite way too, of course. If the dollar strengthens, foreign currency earnings are worth less in dollar terms. But we're specifically discussing currency devaluation scenarios, and in those situations, foreign currency exposure provides powerful protection. During my time managing Magellan, I invested internationally, though it was less common in the 1980s than it is today. I looked for the same characteristics abroad that I sought domestically: understandable businesses, strong competitive positions, excellent management, and reasonable valuations. The geographic location was less important than the quality of the enterprise. The international businesses I find most attractive for currency protection share several characteristics. First, they're based in countries with strong rule of law, property rights, and sound fiscal management. Switzerland, Germany, Japan, Singapore, and the Nordic countries come to mind. Second, they operate in industries with durable competitive advantages. Pharmaceuticals, luxury goods, industrial equipment, and specialized technology all offer opportunities. Third, they have global operations, not just domestic. A company earning revenue worldwide is naturally diversified across multiple currencies. Some examples of the types of businesses I'm describing include Swiss pharmaceutical companies like Roche or Novartis, German industrial companies like Siemens, Japanese consumer electronics and automotive companies like Toyota or Sony, British consumer goods companies like Unilever or Diageo, and French luxury goods companies like LVMH or Hermes. These aren't speculative emerging market plays. They're established, world-class businesses that happen to be domiciled outside the United States and earn substantial profits in other currencies. Many are actually more stable and better managed than comparable U.S. companies. For currency protection through international diversification, I recommend allocating 20 to 30% of your stock portfolio to high-quality international businesses. You can implement this through individual stocks if you're comfortable with international investing, or through international equity, mutual funds, or ETFs focused on developed markets. One important, I'm not recommending currency speculation or trading. I'm not suggesting you try to time currency movements by moving money in and out of foreign currencies. That's a fool's game that even professional currency traders struggle with. I'm simply recommending you own quality businesses that happen to earn their profits in currencies other than the dollar. This provides natural protection without requiring you to predict anything. Asset number 5, precious metals as portfolio insurance. The fifth and final asset that explodes during currency crises is the most controversial on this list. Precious metals, particularly gold and silver. Now, I need to be completely honest with you. I've never been a gold enthusiast. Gold produces nothing. It pays no dividend. It generates no earnings. It just sits there hoping someone will pay more for it later. But, and this is important, gold has served as money and a store of value for thousands of years across virtually every civilization. When people lose confidence in paper currency, they flee to gold. This isn't rational economic behavior in a strict sense. It's human psychology and historical precedent. And we can't ignore psychology when it drives actual market behavior. During currency crises throughout history, gold prices have soared. In the 1970s, when the dollar was weakening and inflation was accelerating, gold went from $35 per ounce in 1970 to over $800 per ounce by 1980. That's a more than 20-fold increase. During the 2008 financial crisis, gold surged from around $800 to nearly $1,900 by 2011 as central banks printed money aggressively. The reason is simple. Gold supply is relatively fixed. You can't print more gold like you can print more currency. Mining gold is expensive and time-consuming. When currency supply expands rapidly, gold's scarcity becomes more valuable. People view it as a safe haven, a form of money that can't be debased by government policy. Silver shares many of gold's characteristics, but has additional industrial uses in electronics, solar panels, and medical applications. This dual nature as both a monetary metal and an industrial commodity can make silver even more volatile than gold, but also potentially more rewarding during currency crises. Now, here's my honest assessment. I would never recommend putting your entire portfolio or even a large portion into precious metals. They're too volatile, they produce no income, they're purely speculative stores of value. But as portfolio insurance, as a 5 to 10% allocation that provides protection in the specific scenario of severe currency devaluation, they have a legitimate role. Think of precious metals like insurance on your house. You hope you never need it. It doesn't generate income. It costs you money in the form of insurance premiums or, in gold's case, storage. Costs and opportunity costs. But if disaster strikes, you're grateful you have it. In a severe dollar crisis, that 5 to 10% gold allocation could surge to represent 20 or 30% of your portfolio as gold prices explode, providing exactly the ballast you need when everything else is struggling. How should investors implement precious metals? I see several options. Physical gold and silver coins or bars stored securely. This provides direct ownership but requires secure storage. Gold and silver ETFs that hold physical metal in vaults. These provide easy buying and selling without storage concerns. Mining companies, stocks that benefit from rising metal prices. These are more volatile but offer leverage to metal prices. Precious metals, mutual funds that hold diversified baskets of mining companies. My recommendation for most investors is keeping it simple. 5 to 10% of your portfolio in a combination of physical precious metals or precious metals ETFs with perhaps a small allocation to high-quality mining companies if you want additional upside potential. The key is understanding what you're buying. You're not buying an income stream. You're not buying a productive asset. You're buying insurance against currency catastrophe. Set appropriate expectations. Don't check the price daily. Don't get emotionally attached. View it as portfolio ballast that you hope never becomes your best performer, because if it does, it means everything else has gone wrong. Now let me show you how to combine these 5 assets into a complete portfolio designed to protect against significant dollar devaluation while still providing growth in income in normal economic environments. Let's assume you have $500,000 to invest and you want meaningful currency protection. Quality dividend-growing U.S. businesses, 40% equals $200,000. Focus on companies with pricing power and essential products. Examples include Johnson & Johnson, Procter & Gamble, Coca-Cola, Walmart, and similar stalwarts. Real estate investment trusts, 20% equals $100,000. Diversify across industrial, residential, healthcare, and infrastructure REITs with strong balance sheets and inflation-adjusted leases. Commodity and commodity-producing businesses, 15% equals $75,000. Split between energy companies like ExxonMobil or Chevron and agricultural businesses or farmland operators, international businesses earning foreign currencies, 20% equals $100,000. Focus on quality companies in developed markets across Europe, Japan, and other regions with sound fiscal management. Precious metals as portfolio insurance, 5% equals $25,000. Hold through physical gold or gold ETFs with perhaps a small position in quality mining companies. This allocation provides multiple layers of currency protection. The dividend-growing businesses can raise prices and dividends. The REITs own real assets that appreciate with inflation. The commodity producers benefit directly from rising commodity prices. The international businesses provide foreign currency exposure. The precious metals offer pure monetary insurance. But here's what's beautiful about this structure. It's also an excellent portfolio for normal economic environments. These aren't speculative assets you're buying purely for currency protection. They're quality investments that should perform well regardless of what happens to the dollar. If the dollar remains strong, you still own productive businesses generating growing income. If the dollar weakens, these assets provide exactly the protection you need. As you look at these 5 assets, you'll notice a common theme. None of them are financial promises. None are bonds promising to pay you fixed amounts of devaluing currency. None are cash sitting idle losing purchasing power. Instead, they're all real assets or productive enterprises. Businesses producing goods and services, real property generating rents, commodities with practical utility, foreign businesses earning other currencies, and precious metals with monetary characteristics. This is the fundamental principle of currency protection. Shift from being a creditor to being an owner. When you hold bonds or cash, you're a creditor. Someone owes you a fixed number of currency units. If that currency loses value, you're destroyed. But when you own businesses, real estate, commodities, or precious metals, you're an owner of real assets whose value adjusts automatically as the currency changes. This philosophy guided my entire career at Fidelity. I focused on ownership of quality businesses at reasonable prices. The same principle applies to currency protection. Own productive assets. Own real things. Own enterprises that can adapt to changing economic conditions by raising prices, increasing earnings, and growing value. Let me close with an important point about timing. The time to build currency protection isn't after the dollar has already collapsed. By then, the assets I've described will have already surged in price. Quality businesses will be expensive. REITs will have risen. Commodity stocks will have soared. Gold will be at all-time highs. Everyone will be panicking into these assets simultaneously, driving prices to unsustainable levels. The time to build protection is now, during relative calm, when these assets are reasonably valued and available. This is the same principle I applied to all investing during my career. I bought stocks when they were ignored, unloved, and reasonably priced. I didn't chase them after everyone else had recognized their value. Right now, quality dividend stocks are reasonably valued by historical standards. REITs have corrected from their peaks. Commodity stocks are not in bubble territory. International markets offer compelling valuations compared to U.S. markets. Gold is well off its all-time highs. This is the environment for building positions deliberately and rationally. Whether the dollar experiences significant devaluation or maintains its strength, the portfolio I've described represents sound, long-term investing. These are quality assets that should serve you well through various economic conditions. But if currency concerns materialize, you'll be positioned perfectly while others are panicking. That's the essence of good investing, preparing for multiple scenarios while maintaining flexibility and owning quality throughout.